All right, looking at some gains. Could be 2 days in a row. Enough of these fluctuations. 30 minutes until the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, stocks shake off trade jitters as tech optimism and strong earnings keep momentum going.
While the U.S. continues to play hardball with China, global CEOs, including Apple's Tim Cook, meet with Beijing's top trade negotiators.
And Fed Governor Christopher Waller comments on the careful cuts that he wants to see, weighs in on the economic impact of AI as well. Dani, what are you watching?
It's another day where we have some other great news about AI that's lifting up. Every day, but we keep putting stocks up. It doesn't matter. I guess it's not in the price this morning, Matt. It was TSMC. The ADR is trading 2.2% higher. They raised their projections for 2025 for revenue growth for the second time this year. They continue to benefit from that spending spree on AI infrastructure. I'm sure like in another couple hours, we'll get another news of some other AI
Absolutely.
deal.
And I'm overwhelmed with pitches for AI guests. I get it. There's AI happening every day. Salesforce expects revenue growth to return to double digits in the coming years, forecasting $60 billion in annual revenue by 2030. And as a result, we can see CRM up more than 6%, Dani, in the pre-market.
A lot to be excited about for tech this morning. Let's get more on TSMC and Salesforce. We're joined by Bloomberg Tech co-host Caroline Hyde. Caroline, just looking at TSMC, again, I'm surprised that this isn't already kind of priced in. It feels like there's already a lot of hype, but TSMC says things are good. The AI hype is real, and we send shares higher.
It's real. And what's important is also they're only increasing their revenue expectations by 1 or 2 percentage points more broadly. But this is just setting the record straight that even with China pulling away from wanting to build its own chips using the Taiwanese TSMC. Remember, TSMC is the leader in the most sophisticated chips when you're thinking 2 nanometer, 3 nanometer, the nodes, as well as then packaging. They have just owned the space when it comes to NVIDIA, when it comes to Apple, when it comes to any consumer good, as well as your AI accelerator. But they have seen revenue from China, and now that might be pulling away. But really, the CEO managed to steer the market to say, look, even with China pulling away, in a similar echo to what we heard yesterday out of Samsung and others, is the like that even if we don't have that strength of market, we will still be there to grow and accelerate. Look, ASML was with a similar pitch yesterday. Even with China at the moment making 42% of its revenue and it pulling away, they will still see the momentum. The mega trend is what TSMC is calling it. That's why TSMC is up so much this year, why it's worth more than $1.25 trillion if you convert it into United States dollars, and why they're at a record high today.
You know, it's interesting. On the same day that we get a Ken Griffin statement that AI makes no difference for them, right? And it makes no difference for us. Salesforce says it makes a difference to them, but we should have known this. Why is this not already priced in?
Well, Salesforce is saying 100 million is how much they are saving. What I think is kind of a red flag here is that they're having to use their own self as the case study. Yes, they're trying to talk about the work that they've done for PepsiCo and some other key companies, but this is a business that's trying to persuade others that, look, OpenAI and the startups aren't coming to eat my lunch. Software is still in there. We've already got our tentacles into so many businesses. And when we've managed to train up that workforce, they will be able to see the superpowers of Agentforce. This is really, once again, Mark Benioff trying to play the trend, but really convince people that his stock shouldn't be down almost 30% on the year, that actually he can see a return to growth. And the CFO, COO, who's combined role, Robin, she's trying to say that actually they are at that pivot point. By 2030, they can almost double their revenue. But the proof is going to be in the pudding. We need revenue growth to actually go back to double digit, because it did sink off to single digits.
By the way, I am going to be speaking to Citadel's chief technology officer around 4 p.m. today. I'm going to ask him about those Ken Griffin comments, but he also said to me that they are using AI. It just helps with productivity. It just doesn't give them alpha.
No, exactly. Like, I get that it can help them in the back office, but they're not beating people in the market because of it, which
correct.
I think was Griffin's. You're to do another conference today?
Yeah, because I haven't had enough. I haven't had my fill.
You've never said no.
I don't know those two words.
All right, Caroline Hyde, looking forward to your program at 11 a.m. This morning. She co-hosts, of course, Bloomberg Tech. Now, United Airlines said it expects demand for premium seats to drive profit through the end of the year. The company's CEO, Scott Kirby, joined Bloomberg TV in the last hour.
First 3 quarters were really good for United in a lot of macro volatility that happened for the aviation industry. That demonstrates the resilience of our revenue diverse, brand loyal business model. But you look to the fourth quarter, it's even more exciting because as the economy is starting to get back to a solid footing, at least for aviation, demonstrates a lot of upside. We think we're going to be able to grow earnings for the full year, even in this environment. So it really is creating value for all of our customers.
For more on United, we're joined by Sid Phillip, Bloomberg's chief correspondent for aviation and transportation. Sid, you and I were sitting here last night breaking down these earnings. They looked really good, and yet the shares are down in the pre-market. What's going on?
I think everyone's looking to see what United is going to basically do for the rest of the year, and also they're spending a lot of money on their upgrades and their capex. I mean, they said they're going to spend $1 billion on cabin upgrades and basically improvements next year. I think that's sort of weighing in terms of, are they spending too much on upgrading the aircraft, upgrading the in-flight experience, and essentially there is concern about whether that premium boom is going to keep going.
Because that is a big risk, right? If you have this scenario where they've spent a lot of money and then all of a sudden the cycle turns, are they prepared for any sort of backstop? Have they talked about concerns on the broader macro environment if the feel-good times cease to exist?
Yeah, what if there's a government shutdown, for example?
So far they're saying that there's no impact from the government shutdown. But I mean, we're looking to see, as this prolongs, how it's going to affect air traffic. I mean, not just United, but across the industry. Air traffic controllers are already sort of calling in sick, and that's sort of causing delays. We could see more of that, and that's sort of a concern across the in terms of the economy and in terms of the aviation industry. As will airports continue running? Will TSA continue to be operating?
So first of all, we pointed out yesterday that they had the best third quarter for the least cancellations in any third quarter in the history. Plus, 6 out of 7 hubs, they're either number 1 or number 2 for on time. But Dani, you in the last week, you've flown to the Dominican Republic, you've flown to Los Angeles, you've flown back here. How many of those flights were delayed?
Half of them. Half of them were in like monster delays, like 5-hour delays. And they blame weather for a lot of these things. But how much of it is also just like there's a government shutdown and things aren't functioning as smoothly as they should be because of that?
I mean, we've seen instances of it. Like last week, we saw instances where Chicago was sort of having staffing controls, and that was sort of causing delays. We've seen instances in Dallas where delays have been caused because of air traffic control staff shortages. And so it is across the board, and it isn't very prevalent at the moment. But the longer this goes on, that's probably going to increase, and we're going to see more impact on the ground.
I'm going to Austin this weekend, so I'll get ready for even more delays and even more time at the airport. Sid, thank you so much for your reporting. Bloomberg's Sid Phillips. Now, elsewhere, global CEOs, including Apple's Tim Cook, met with China's top trade negotiator as tensions simmer between Beijing and Washington. Bloomberg senior editor Mike Shepard joins us for the latest. Shep, what do we know about this meeting and what was discussed?
Well, we don't know what happened behind closed doors there, but the timing of this get-together is unusual, mainly because of the rising tensions between Beijing and Washington over trade, and the fact that it's coming less than 2 weeks before Presidents Donald Trump and Xi Jinping are set to meet to try to sort out this growing list of differences between the world's 2 largest economies. And companies like Tim Cook's Apple have so much at stake in all of this. China is a market that they have been betting on for years, but now the Trump administration and even its predecessor, the Biden administration, have been pushing companies to maybe de-emphasize, if not decouple altogether from China over national security concerns and economic competition concerns. Earlier this week, ahead of this meeting that Tim Cook had with He Lifeng, Apple made 2 announcements that were curious. Tim Cook, on one hand, pledged greater investment in China. Yet on the same day, Apple was also unveiling plans to produce its home hubs and some robotics products in Vietnam in a pivot away from China. So, Dani, this signals that companies like Apple are really at this crossroads caught between 2 economic superpowers.
All right, Mike Shepard, thanks so much for joining us. Mike Shepard out of Washington, D.C. Earlier this week, the IMF warned that the global economy is showing signs of strains from sweeping U.S. tariffs and protectionism. Bloomberg's Lisa Abramowitz is at the IMF headquarters, also in Washington, for the annual fall meetings, and she's there with the managing director, Kristalina Georgieva. Lisa?
Thank you so much, Matt. I am here with Kristalina Georgieva, the managing director of the International Monetary Fund, at a time when the world leaders are all coming together. We spoke back in spring, and you seemed just a little bit more concerned. So did everybody here. There seems to be a more optimistic tone. Why is that?
Because since the spring meetings, we have seen the world economy being quite resilient, and very important, we have seen countries acting responsibly towards their own interests and the interests of the world. Let me unpack this. One, we have upgraded our growth projections since April. Why? Because performance across the world is quite strong. Why is it strong? Because the tariff shock from the United States is not as dramatic as we feared in April. In April, if you recall, the announced tariffs were 23%. Today, US tariffs nominally 17.5%, but what is being collected is somewhere around 9%. So smaller shock from the US. Two, what did the rest of the world do? With the exception of China and initially Canada, that retaliated against the United States, the rest of the world said, not tit for tat. We are not going to engage in retaliatory action. So we have 191 members. 188 of them decided to trade by the rules that exist. And the third very interesting thing is, you now see the value of strong fundamentals. Countries have built good institutions, they have built good policies, especially in the emerging world. Now we are seeing the payback from that investment.
So is this the reason why you think that it's legitimate for the market to be looking through some of the recent flare-up in tensions between the U.S. and China? Because ultimately trade keeps going, and the world has sort of shown that it isn't really willing to escalate to that degree.
That is exactly the reason why everybody's calmer, even if China-US tensions go up and down, because there is no spillover. But let me say this, we shouldn't be complacent. What we see is that Chinese goods that used to come to the United States are now redirected to Asia and to the European Union. If these recipients of Chinese goods feel the heat and decide that they too should impose tariffs, we may still have the risk of a trade war moving from one place to another. So our message to everybody is be calm, and to China, be careful. Do not provoke other countries to see you as a threat to their economies.
You talk about emerging markets and the resilience that we've seen there. You talk about the potential lack of resilience in the developed world because of the fiscal overhang. Are you starting to see EM-like dynamics in the developed world?
When we look at the prospects for the world economy, they're underwhelming. Growth is slow, debt is high. And who leads on the debt front? Advanced economies. They have borrowed to meet the needs of people during COVID, when we had the shock from Russia's war in Ukraine. Now they need to pull back what they're providing as support, and it is very difficult. People like receiving, they don't like losing what they have got. So we see everybody recognizing that debt needs to go down, that fiscal consolidation needs to take place. Here in the United States, Secretary Bessent says we need to get to 3% deficit. But acting on these intentions is hard. Where I want to shout bravo to Italy. Traditionally, Italy was a country that was seen as having real difficulty to tighten up. Now they are very likely to go below 3% deficit next year. So there are some bright spots. Greece is a fantastic story. There are some bright spots, but still bright spots on a dark horizon.
Well, and they had to get to a pretty dark place before they got to that bright spot. And I do wonder, I mean, how much it's screaming into a void, reduce your debt, and everybody wants to keep getting their benefits. But I do wonder whether you see the ramifications of this in the price of gold, in this conversation that we have here about the debasement of the dollar. Do you think that those threats are real?
The price of gold is going up because uncertainty has shot up and it is staying very high. What do you do at a time of uncertainty? You try to anchor yourself in something that has proven value. When we look at the dollar, over decades, the share of dollar in reserves globally has gone down somewhat, mostly because other countries have presented a good alternative. But they are all medium-sized countries. Australia, Sweden, Switzerland. Even the Eurozone is not that big to present an alternative to the dollar. And we need to remember, people go for the dollar because of the depth of the capital markets in the United States, the liquidity, the size of the economy, the productivity of the American worker, which is unmatched in other advanced economies. So yes, it is likely as the world becomes multipolar, it is likely to see this trend, but it is a slow process.
I also want to ask you about Argentina. The U.S. recently had this $20 billion swap line. How is the IMF involved in that effort, if at all?
We work hand in hand with the Argentine authorities and with the partners of Argentina. First and foremost, U.S. Treasury, because of the size of their support, but also the World Bank, the Inter-American Development Bank. And we do it because we see a genuine change for the better in Argentina. Over the last 2 years, what have we seen? From negative growth to 4.5% this year, and this is slower than last year. Inflation from triple digits down to 28%. Deficit gone. Instead of it, there is surplus. Very important. Poverty trending down. That means that there is something happening in Argentina that is good for the future of Argentina.
If Javier Milei does not win the election, do you still have that optimism?
Well, he will be there. He will be the president for some time to come. And I think that there is a still fairly strong support in Argentina for getting the country to be a normal economy in which regulations are meaningful and for purpose. There is a very big regulatory house cleaning that is taking place in Argentina. So I expect that even if we are in a somewhat different place, and frankly, we don't deal with politics. It is for the people of Argentina to decide. But when you look at the strength of the economic position of Argentina, it's good to sustain the country going on that path.
Kristalina Georgieva, thank you so much for taking the time. Always a pleasure to speak with you. That was Kristalina Georgieva, the managing director of the International Monetary Fund here in Washington, D.C. Matt, Dani, I'll send it back to you.
Sending the message of calm. Lisa, thank you so much. Bloomberg's Lisa Abramovitz speaking with the IMS managing director. A quick look at futures this morning, up again this morning, very much so matching my jacket. I guess I picked the right outfit today. Up for a potential second day with some of the volatility in yields easing out. There were some bad numbers from the Philadelphia Fed index this morning. We started to get back down to 4% for the bond market. That has ceased. We are up mostly with tech, Matt, thanks to TSMC, thanks to Saleforce. The AI megatrend is still alive and well, says TSMC.
I will say you're going to see a red arrow if you look at bonds today,
True.
right?
Yeah.
Price down, yield up, and that Philly Fed number gave us a really sharp reversal because we'd been coming down to the lows on the 2-year, right? We were at 348, and now we're back up to 350 on the 2-year. The 10-year not moving, well, neither moving very much. It's just that if you look at the GIP chart, right. Here you see the very sharp reversal. So definitely a space that we want to keep our eyes, our collective 4 eyes, Dani, and then all of our viewers as well, trained on. Coming up,
many eyes.
Robinhood's Chief Investment Officer, Stephanie Guild, shares her market outlook. She's bullish on cheap tech, if you can find it, defense, and regional banks. This is coming up next.
And happening right now, Fed Governor Christopher Waller sitting down with Bloomberg's Tom Kein at the Council of Foreign Relations. Governor Myron hitting back at Waller's insistence for 25 cuts, saying 25 basis points of cuts is making adjustments slower than need. Will Waller respond? You can watch that conversation live go on your terminal. This is Bloomberg.
That view was echoed in the Federal Reserve's recently released Beige Book, which is a survey of business contacts. The consensus view across the country is that while consumer spending inched down.
Let's get now to high interest. Look at what's making headlines around the world. Israel and Hamas are clashing now over the return of dead hostages. Hamas says it handed over all the bodies that it can locate and reach in the deep rubble of Gaza, while Israel insists it's still owed at least a dozen more under the U.S.-backed ceasefire deal. The dispute comes as the fragile truce enters its next phase, with questions mounting over reconstruction aid and the future security of the Gaza Strip. Billionaire Paul Singer's Elliot Investment Management is raising billions of dollars in new cash as the hedge fund readies a war chest for new trading opportunities. The firm is going to take in up to $7 billion that will need to be called as needed, a private equity style mechanism the firm has used in the past to invest gradually in emerging opportunities. And billionaire investor Ken Griffin, we were talking about this earlier, he says generative AI has not helped hedge funds beat the market and remains overhyped for finance. Speaking at the JP Morgan Robinhood Investors Conference, the Citadel founder said the technology boosts productivity but still falls short at finding alpha, and it won't trigger sweeping changes across the industry anytime soon.
Let's get a quick check on futures because everyone is excited about AI, even if Ken Griffin isn't. We are higher by 0.5% after TSMC talked about the mega trend of AI alive and well. We're up by 1/3% for the S&P, Matt.
Let's take a look at some of the other movers on our radar and the I can't speak this morning.
That's okay.
It's
Speaking's
tough.
overrated.
I won't have to soon enough because a robot will take my job. Doordash customers in the Phoenix area may soon have their orders delivered by an autonomous vehicle from Waymo. Doordash shares jumping on the news of this new partnership while Uber shares are down.
This to me is kind of sad, because we've created this economy where so many people have had to change and become gig workers, whether it's delivering for DoorDash, driving Ubers. I look at this news and I think, okay, we're also taking those jobs away now. We're going to be replacing those jobs too. What happens to this labor market?
Yeah, well, eventually we're going to sit on mechanized chairs drinking ices on the deck of a ship.
The universal income.
Universal basic income.
Yeah, exactly.
I think this is interesting in another sense, and that is I heard on surveillance radio this morning about people ordering in. It's almost half of all eating is done by ordering from out. This came in a Torsten Slok email, and now everyone's talking about it at the water cooler. So I never eat out.
I do maybe on the weekends, but I wonder if it's also just like we got so used to ordering things at COVID. We all got super lazy, and we decided that that's how we live now, and we will continue to order in, even if some incomes are starting to get stretched.
All right, HPE also delivered a disappointing profit forecast after ringing the bell yesterday, reflecting a margin crunch in the AI area. The company said it's planning to cut jobs as part of its integration with Juniper Networks, but the shares are down almost 8% in the pre-market.
We also had JB Hunt reporting better than expected earnings, citing better cost controls, and we will get more on those results later this hour with Lee Klasko of Bloomberg Intelligence, with shares skyrocketing up 15.6%.
Less than 4 minutes until the opening bell. Robinhood's Chief Investment Officer, Stephanie Guild, joins us next. Could be a day of double gains. This is Bloomberg Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We have had some amazing market gyrations in the last few sessions, kicked off by concerns about the trade war that President Trump yesterday acknowledged in those words with China. However, we closed higher, and now we're looking at futures gaining as well. So we could have a little bit of stability back in this market. S&P futures up, NASDAQ futures gaining, Russell 2000 futures up as well on this Thursday morning. You've got the Susan G. Komen Foundation ringing the opening bell at the NASDAQ. Just to point out, it is Breast Cancer Awareness Month, so they are all wearing pink and trying to raise awareness there. Down at the NASDAQ, you've got an Asian fintech company, Owlting, ringing the bell, and they're doing a direct listing on the NASDAQ. The ticker is OWLS. Dani, what are the stocks that you're watching today?
I'm watching tech and AI, as we are literally every single day, because it's another day where there's positive news that's juicing this equity market and tech stocks in particular. TSMC, the ADRs, though, I have to say they're trading off of what we were in the future session here at the open, only up 0.6%. They were up more than 1% in the pre-market trade, but it raised its projection for 2025 revenue growth for the second time this year. They keep benefiting from a spending spree on AI infrastructure. All right, there we go. Now we're up by more than 1%, Matt.
All right, Saleforce as well is an AI story. It expects revenue growth to return to the double digits in the coming years. It had dropped below that, obviously, and now it's got this agent force, I think that's what it's called, that it hopes is going to boost revenue to $60 billion annually by 2030. City strategist Beata Monte warns that the equity bull market could be headed for a choppier phase amid a complex path to a resolution of the U.S.-China trade dispute. That is indeed what we've seen over the past couple of days. Worries about rare earth magnets need to lead to threats about less recycled oil, cooking oil. Joining us now to discuss is Stephanie Guild, Robinhood Chief Investment Officer. I didn't properly illustrate the picture, but you know, it's the rare earths and then the soybeans, I think, is what made us want to buy
rare earth cooking oil,
less recycled cooking oil. In any case, it's really driven these market gyrations. Yeah. So how does this get resolved?
I don't know if it does. I mean, I think China's the only country that can actually stand up against the U.S., right? It's why the other ones haven't. I saw the other day that China had put that announcement that they had put out there that had gyrated the markets in their own word processing system. So you couldn't actually read it if you were using any of the ones that we use. And it just shows you how independent they've tried to become. And it's why I think they have leverage here. The only, cooking oil, I guess, is the leverage point.
Yeah.
But it's why actually we've been invested in China tech in our portfolios in Robinhood strategies, because we think that's a place that can give the U.S. tech market a run for its money.
The bulls for U.S. equities, though, would say, look at their earnings this week. They've been really strong, banks and United and otherwise. AI trends still going strong. We were just talking about TSMC. Does it surprise you that trade still has the ability to rock this market and cause volatility, despite the fact people looked at Trump and just said he'll always back out and maybe don't necessarily trade on it? The fact we are still trading day to day on the latest trade machinations?
Yeah, I think it's just because of where we are in terms of like the valuation cycle. Like it is, you have to see a much bigger, everyone expects high growth from the tech sector. Everybody expects, I think, things to go well. Like JP Morgan had good earnings. It didn't move materially higher that day because the expectations are already there and they are everything. We also have a government shutdown. Like there are things to worry about. And the one area that I'm actually watching very closely is like the credit markets and some of the things that are starting, like Zion's provision.
The great cockroach debate.
I actually agree with that.
So what do you think? By the way, Dani got deep into that.
I did get deep into
yesterday.
It. Well, there was this whole argument. I talked to Mark Lipschultz of Blue Owl, who was like, I'm not the cockroach, you're the cockroach, saying it's not private capital, private credit, it's public credit. But maybe it's credit as a whole that has an issue, and we shouldn't be making these distinguishing factors.
Is it a problem?
I mean, if you look at the details, like tons of private money has flowed into private credit, like tons. It was all private banks could talk about. And there had to be some point, a space where the due diligence got a little light. Let's just get this money invested. Like that's what I'm worried about. I'm worried about it in the private credit market, private equity markets as well, in certain spots, not everywhere.
I have to say, I was looking at this comment from Mark Nachman, the head of global wealth at Goldman Sachs at GSAM, who basically said that so much money was flowing in that there had literally been IC meetings. He said, of course, not Goldman Sachs's, but investment committee meetings where the IC got overruled because they were like, it doesn't matter how good this deal is, you have to put the money to work. If that's happening, Stephanie, what's the logical conclusion to that? And is it just a private markets issue, or do we need to start worrying if you're invested in public markets too?
No, I mean, I think there always will be some sort of follow through somewhere in the public markets. So far, the issues in the credit space have been, everyone's blaming fraud, which brings you back to due diligence. It's been more in the auto sector. So I just wonder if there's like that consumer, you couldn't buy a car during COVID, everyone jumped into used cars, and that's kind of where you're seeing it so far.
So much money in private equity that someone's making a bid for Papa John's. Is
that a sign at the top?
I mean, it's like if you have a choice of where to order pizza.
It's cheap.
Is that?
Hey, Blackstone bought Jersey Mike's. That was exciting.
But
Jersey Mike's is delicious.
I mean, if you can order it through OpenAI and then your Waymo driver gets it to you,
Hey, I teased that we were going to ask you about cheap tech. Is there any buying?
I mean, we've found some. That's where, it's riskier for sure because it's not like the most obvious places, but I still think it's kind of the picks and shovels. So NetApp is one name, for example, that's priced at 14.8 times, which is a discount to the S&P, discount to obviously the sector. It's under the radar. Only 30% of analysts have a buy rating. It's not, as I said, not for the faint maybe of heart, but it feels like there are some names that are under the radar.
Well, I was talking to one of our in-house quant strategists, Stephen who basically said he had built this strategy that's looking at unprofitable companies that have momentum to becoming profitable. And he said a lot of it was in unprofitable tech. There's been so much noise this year made about how that sector is outperforming. Are there actually maybe some gems in there, to your point, that yes, it's unprofitable now, but seems like they're improving?
Yeah, I mean, I think that's always the case. It depends on where they're focused. I think, but if they're able to create some sort of niche area, I mean, you could also say CRM is cheap.
True.
Right? Because it just hasn't delivered on, they haven't leveraged as much as kind of their customer base.
Do you like CRM after the earnings yesterday?
It feels a little bit still like a show me stock to me because obviously the stock is up, but it's been doing nothing for a while and they just keep saying, yeah, it's coming. So now for us, it's a show me stock, but we liked it for a while. We just didn't make any money in it. So we just kind of said,
well, wait and see. What about software in general? I mean, does AI just eat software?
Maybe. I don't know. I think AI still has things to improve on. I don't know. The mention that you said before in finance, I still think a human plus help from an AI is a better balance than just completely trusting it.
So you're not rolling out AI alpha for Robinhood users, basically. We're not there yet.
We definitely have AI things on the way, but it hasn't been make a decision for you.
Right, fair enough. Stephanie, thank you so much. It's good that we still need humans. Stephanie Guild for now. Stephanie Guild of Robinhood, thank you so much. All right, a check on your equity market this morning, 8 minutes into your trading day. And we are moving higher by 1/3%. 315 names moving higher, as a matter of fact. NVIDIA, top of the pile. It's still the AI, still chip stocks leading us higher. Salesforce is up there too. Stephanie was just talking about them. She says it's a show me stock. Those shares up 7.8% after an earnings yesterday. To the downside, it is Apple leading the pile for the negative stocks, Berkshire Hathaway, Marshall McLennan, and Walmart too. Walmart down 1.3%. Let's take a look at some of the sectors, what those are doing this morning. Would it surprise you that communications and tech is at top of the pile? Probably not. Thank you, TSMC, for saying the mega trend is still here. Financials looking a little bit weaker despite those really strong earnings we've had earlier this week from the banks. Maybe not huge moves off the back of those, but elsewhere you do see most sectors into the green. Again, the only negative one this morning, Matt, is financials, and we're up 1/3%.
All right, interesting that financials, because earnings have been so fantastic, but I guess buy the rumor, sell the news has been a theme. Coming up, more on TSMC's bullish outlook, further fueling, can you believe it, continuing to fuel AI optimism. That's next. This is Bloomberg Open Interest.
Headed for a second day of gains. In fact, we are now above the levels of where we were on Friday when Trump had that tariff announcement. We have shaken off the nerves with Scott Besson saying a meeting between the two world leaders is still on for this month. Shares up by 1/3% for the S&P while tech leads. Let's get you some top calls from the analyst action we're looking at this morning. First up, Lululemon getting downgraded at Bernstein. The analysts there say U.S. momentum is slipping despite a temporary lift from its Amex promotion. Those shares down 0.7. The firm says that growth is hinged on an untested strategy that won't show results for another 6 months. Next up, T-Mobile, that gets upgraded to a buy at Wells Fargo, and it's being called the firm's top telecom pick. They highlight the network's leadership, steady market share gains, and a strong outlook for free cash flow. Those shares up 1/3%. Tesla was initiated underperformed by BNP Paribas Exxon, citing valuation concerns. The firm sees its AI ventures like robotaxi and optimism driving 75% of Tesla's value, despite generating zero sales. Tesla will report its earnings next Wednesday. Those shares are down 0.2%, Matt.
All right, really interesting moves. Now let's get back to TSMC, posting an almost 40% jump in quarterly profit. Another sign, if you needed one, of robust AI spending. Joining us now is Mandeep Singh, Global Head of Technology Research for Bloomberg Intelligence. We get it, dude. We get it. I mean, when these big hyperscalers are spending 60% of their free cash flow, understandably, it's going to benefit a company like TSMC.
Yeah, and look, I would draw attention to two factors. One, like, everyone is concerned about what happens to China sales. Even if China was to open an internal foundry, they still can't match, TSMC when it comes to the manufacturing capabilities. So I feel like there's a bigger threat to NVIDIA from, China doing something on their own with accelerator chips than it is to TSMC on the manufacturing
side. Or China
side.
doing something with Taiwan, right?
Well, that's a geopolitical angle where if something was to really go bad, then yeah, all bets are off in terms of what happens to Taiwan. The other thing I would mention is just, there's a lot of debate right now in terms of what OpenAI is doing with NVIDIA, with AMD, with Broadcom. Well, whether it's ASICs or GPUs, it doesn't matter for TSMC. Even if, let's say, Broadcom is more successful with OpenAI and Google, TSMC benefits. If it's GPUs, then also TSMC benefits. Whereas in the case of NVIDIA, you need GPUs to be the accelerator that everyone uses. So I feel they're somewhat more insulated when you compare them to NVIDIA, and they have a steadier growth path. And that's what shows up in their earnings.
So for our purposes, right, here in New York, as journalists, we're like, yet another bullish headline on, AI spending. But for you, for someone steeped in this, does TSMC actually look like it's being pretty conservative here?
They are, and they have guided to mid 40% AI growth till 2029. So clearly, when I look at that base growing at, almost at a 40% CAGR, it tells you they will not have the fluctuations that an NVIDIA may have. Yes, NVIDIA grew triple digits, but there is a risk that growth can decelerate sharply. In this case, you will see a steady compounding from a company like TSMC.
And maybe the price action currently makes more sense off the back of that, too. The fact that we are unchanged this morning versus in the pre-market when it was up a lot higher. But is there not some tension there? The fact that they're being conservative, but you also have a CEO coming out being extremely bullish saying, yeah, the mega trend, it is here. We have conviction that it will last.
Yeah, and look, in their numbers, when you parse through that 41% growth, 22% wafer growth, 15% ASP growth. So everyone is paying more to TSMC for manufacturing the accelerators because they are the only ones who have the CoWoS capacity and they have the best yields. I mean, even an Intel is a customer of TSMC on the foundry side. So clearly, I just feel like the moat is a lot more stronger and there is no other place to go.
In terms of the chances for Intel to grab some of this business, I keep thinking about it, but it hasn't materialized. I know it's early days. Do they have a foundry business? Do they have a chance in that business?
I mean, the government really would have to push one of these hyperscalers to, source some of their capacity from Intel. Until that, happens, I just feel like, by preference, TSMC will always get that nod. But if it comes down at the government level, then clearly there is a chance that Intel will get some of the business.
Mandeep, you're one of the best. Thank you so much for joining us. Mandeep Singh of Bloomberg Intelligence. Elsewhere, happening right now as we speak, Fed Governor Christopher Waller in conversation with Bloomberg's Tom Kein at the Council on Foreign Relations, talking about keeping steady policy to keep yields in. Let's take a listen.
Not less. A huge body of America doesn't agree with that. And to your point on innovation, with a Nobel Prize, a celebration of the last 48 hours of Schumpeter and McCraw's prophet of innovation, this new innovation, the gains are going to go to a narrow group, or do you think they will, this is a cliché word, they will diffuse out across America?
Well, the history of technology is that they do diffuse. I mean, one of the things I pointed out in the speech yesterday, if you look back to Karl Marx's theory of capitalism, machines, robots would replace labor to produce all the output. Everybody would lose their jobs, be unemployed. There'd be this mass army of the unemployed. There'd be a social revolution. Capitalism would die, and we'd have a socialist utopia. That doesn't happen, right? I mean, when capital goes up, machines and technology go up, it makes labor more productive. And firms like productive workers. And that's why they want to hire them, because they don't want to keep their output constant. They want to produce more. And they need both of these things to produce more output. This is what we've seen in the history, certainly of the U.S. in the last 200 years. The capital stock in the U.S. is 7 times larger than it was in 1950 in terms of machines, equipment, everything. The unemployment rate is exactly the same. So employment grows with technology. It doesn't go negative with it.
But to the president's point, and arguably his election, a huge body of America feels let down. We had productivity, we had capital deepening of an extraordinary amount, and the jobs went to China. That's his theme.
Yep.
With AI, are we going to replicate that in some unknown way, and the jobs are going to go to you name the place?
Well, even with the China shock, total employment in the U.S. has grown ever since the China shock. It hasn't gone negative or fallen. It's just go look at the employment rate. Go to Fred, my favorite data series. Pull up employment. Look what it does. It just goes up. So, yes, there are reallocations. Jobs get lost and they go somewhere else or they get eliminated. But that's my point. New jobs, new things came up. People reskill, go into new areas. So when the China shock was hitting manufacturing, we had a whole IT, software, phone, technology, information technology that created thousands and millions of jobs.
Is Fred an unfair advantage for the St. Louis Fed? Do they wake up every day different than any other bank?
Fred is one of the greatest gifts from the Federal Reserve to the planet.
There we go. Ma'am, please.
Hi, Ginger Cutler. I'm a term member at CFR. Governor Waller, just what you just said about how unemployment is the same as it was in 1950 and the China shock didn't really necessarily affect employment. I guess I want to harken back to what you said about where wealth is concentrated in the hands of Americans, right? And how you said that the bottom 60% of households own 15% of wealth and 45% of spending. I'm curious how that figures into what you just said about unemployment being the same as it was in 1950 and the China shock ultimately not really having an effect on the labor market. I'm curious how inequality factors into that.
Yeah, so like I was just trying to get at with employment, you get sectoral shifts. Some sector goes down, some other sector goes up. In my speech yesterday, I said, look, when automobiles came up, if you were making saddles or wagons, your jobs were going away. But those same skills got transferred over to producing chassis for cars, making car seats. The same skills, they just had to transfer them. So those jobs went away, but other jobs came up that took their place. That's why you can't just look at one sector and say, oh, that's going to kill the entire economy. I don't believe that's going to happen with AI either. In terms of wealth and income inequality, this has been an issue in the U.S. for the last 40, 50 years. There's been a tremendous increase or a reasonable increase in wealth inequality, income inequality. For me as a policymaker, I have one instrument. I can't deal with inequality. It's really not in my toolkit. I can't say here's an interest rate for this group, as Tom was saying. I can't say here's an interest rate with that R star and here's an interest rate with that R star. That's not in my set. I have to look at the aggregate. It's really my only choice. Mm-hmm. Can I look at these discrepancies and think how I might want to lean one way or the other? Sure, I can. we kind of got criticized for that before with our last framework, that we were kind of leaning a particular way. There's nothing wrong with it. It's just there's very little we can do about it. And that was my issue with our last framework. I could care about this, but there's very little I can do with it for particular groups.
I think we have a question here in the digital world.
We'll take the next question from Chris Thomas.
Good morning, Governor Waller. Thank you for the time today. Ex-Intel, ex-McKinsey. Now I help global companies think about their global footprint and where they put advanced manufacturing facilities. And the constant refrain is that no matter how high the tariff, the U.S. is just completely uncompetitive, and now it's the most expensive place in the world to do business, especially if you're building something. To what extent does this matter for the growth and success of the U.S. economy, and is there anything that could be done about it? I've heard that even if it's 100% tariff, it's still cheaper to manufacture in Taiwan or Vietnam or Japan or Korea or China than in the U.S.
Yeah, I mean, this is way outside my wheelhouse, I have to say. Trade policy, particularly worrying about one sector over another, manufacturing versus others. This is just something I can't make those decisions. That's what the president got elected to do, and he's following through on his promises. Whether you get stuff onshoring or not, I don't know. We'll see. We did learn something with the pandemic, that supply chains stretched across the globe are pretty fragile. And there was a lot of emphasis on getting nearshoring, maybe not onshoring, but nearshoring as a result. Over time, if tariffs were big enough, I'm pretty sure you'd bring your factory back. There is a price at which you will bring it back. It's not infinite. So that's what I don't know. We'll see how this all works out, whether there's a lot of incentives to bring stuff back or not, or whether the people that, you bring these jobs back, whether people want to do them or not. I mean, in the U.S., we've moved into much more of a service sector mentality, and the idea of screwing lug nuts on a tire for 8 hours a day is not something most Americans typically want to do.
Well, I'm not going to ask you about bananas and tariffs, because I don't think we're growing bananas. Sir, over here, please.
Hi, Andrew Watrous with Morgan Stanley. Governor Waller, thank you for your comments. I want to ask you to say a little bit more about what you are intending to convey with the phrase "to a more neutral stance of policy." In a sense, if you're restrictive, just cutting once is moving to a more neutral stance of policy. Or is this describing sort of a process where over several meetings you have an idea of a range in mind that is more neutral, and you're describing a process of moving towards that range?
Yeah, I'd say it's the latter. It's really the process. So if you're at neutral and you think you're restrictive and your policy rate is set up here, what's going to cause you to bring it down? You think inflation's coming back to target? You think the labor market is either stable or weakening? You want to kind of bring it back towards neutral. It doesn't mean you go below and you want to stimulate the economy. Things would have to really get bad. We're not seeing that in the labor market, that we want to go below neutral. Or I'm not seeing it. I can't speak for anybody else. The debate right now is about inflation. Inflation's running 3%. It's way over our target. It's been above target for 4 years. Why are you lowering rates? So you have to say, what is the outlook for inflation? And that's what I've argued, that any tariff effects are going to be temporary. This is a classic line in central banking. You look through those things. You think about what is going to be inflation 12 months from now, not when the next 12 months. So that's what I'm doing. And in that world, I see inflation coming back down to target. I see a softening labor market. So I want to bring things back to target. I don't want to go below target right now because inflation is above target.
In Q&A, we go to tenths of a percentage point. You were talking whole numbers up there. You say 2% is where the Fed is right now. What is the latest thinking you see around the raging debate to take a Taylor rule, look at the output gap, look at NARU and all the rest of the mumbo jumbo, and plug in a more normal 2.2 or 2.4 or 2.6% run rate versus the decades-long hope for a 2% inflation?
Change the inflation target?
Yeah.
Yeah, I mean, there's always a good argument or debate about should you pick a point or pick a range. A lot of central banks in the world, they run with a range. They don't seem to have big problems with that. Like the Bank of Canada has a range of 1% to 3%. So, there's often a question of you're just as happy with 3% inflation as 1%. No.
Should we be?
No.
Should we
They
be?
want 2, but they're not going to do crazy stuff to get it to 2. That's the key point. You'll get there. You'll take your time, but you're not going to do drastic policies to drive it to exactly 2. I think 2 is a good thing. I'll give you my spiel on it. What's the real value of having a 2% target with a particular price index? It holds you accountable. If I just said, inflation in general, somewhere between 1% and 3%, there's a lot of loose things that go on in there that I could always slippery slide, say, I did my job. What are you talking about? That happened with the money growth targeting back in the early 80s. Yeah, M1 was pretty good, but M2 was lousy, but next month M2 was...
Remember how the world stopped? I think it was Thursday at whatever it was, 3:30 for M1, M2,
Oh, yeah, it's money growth target. So I like 2% because it holds me accountable. Okay, now, you want to hold me accountable because it's 2.2 instead of 2? Ah, come on. That's where a range kind of helps. I always like to tease my friends and things. In the year 2000, if I had told you the Fed would keep inflation between 1% and 2% for a decade, everybody in the year 2000 said, that is a phenomenal monetary policy success. But because it ran 1.7, we didn't hit 2, it was a failure. Think about that. 1.7, not 2, was a failure. But if I'd asked you before any specific 2% target, you said 1 to 2, that's amazing. That is phenomenal monitoring. So that's the danger with the 2%. It's so precise that if you don't hit it, you start saying you're failing and hitting your target. That's why I actually kind of like a range myself.
I want to talk one final question here from me about the culture and the fabric of America and our economics. There is such a conceit and bias and a distrust back to 1907 or even before of 3 zip codes in Manhattan, or maybe the corridor from Washington up to Boston. You represent a part of America, some would say the backbone of America, from Bemidji, the Dakotas, Bemidji, all the way out to Washington State and then to St. Louis. How would the Federal Reserve System change under a Chairman Waller, given that cultural geography versus every day the East Coast certitude? It's the heritage of the modern economic Fed.
Well, I mean, this is one of the brilliant aspects of the design of the Fed. I've studied the structure of the Fed for 40 years now. The whole idea was to say, look, you need some political accountability in D.C., but you want to have a lot of this outside of D.C. That was the typical grassroots, get people away from D.C., talk to the American public. I always say we're the one government agency that has contact with all parts of the U.S. through our 12 districts and all the branches in those districts. Everybody can come talk to a president of the bank. They go out regularly, speak to the public. You can come talk to them. You can have a conversation with somebody. I mean, the only other institutions that have that kind of contact are the IRS and the post office. And we typically don't want to have them knocking on our door. So that's one of the big advantages of the Fed in our structure of having people on the outside. There has been debates forever of moving more political accountability to the Fed or moving it away. Sometimes people's views shift back and forth depending on what the situation is. But I believe the basic structure that we have has served the country well by representing all the country in the decision-making process, just not a few handful of elites in Washington, D.C. So that, I think, is important. I would say, like I said, for me, one of the critical things, I'd change the S&P. I would encourage dissents. I'm not somebody who's afraid of like, oh, if you're dissenting against what I'm pushing, that lowers my confidence or my credibility.
It'll be so much better for us. 5-4 votes, it'll be, I highly recommend lots of dissents. Yeah. It'll make the Fed show better.
Well, I just think that's the whole point of it. That was the idea of the structure, was you put 19 members so you get this diversity of views from around the country coming in, different points of views. If everybody comes in, no matter what part of the country, no matter what the situation is, and you always say the same thing, we don't need it, Just have 3 governors and that's it at the board and you're done with everything.
Governor Waller, thank you for joining the Council on Foreign Relations.
Fed Governor Christopher Waller there speaking with Bloomberg's Tom Kein at the Council on Foreign Relations. And, it's so interesting that he is this sanguine about inflation. The Fed has a 2% target, and he says you want to get close, like 2.2 is okay. But right now we're at 2.9, right? We're 50% above the Fed's inflation target. And if I said, I'm going to pay you $100,000 a year, but this year I'm only giving you 50 grand, which is close enough, it wouldn't feel close enough to you, right? And this is also on the wrong side of that target. I think it's more important to err below than above. So if you're this far above, it really seems, I think, tone deaf.
You and I picked up on exactly the same thing. And I think perhaps what people will look at is Christopher Waller saying 2% is an important target for us because it holds us to account. It keeps us accountable to make sure we don't get too far outside. But to your point, Matt, we haven't hit 2% in 4 years. And it's not that we're at 2.2. To your point again, we are at 2.9%. Now, I think Waller is trying to make the argument that that interest rate is impacting different groups differently, hence why he wants to continue to cut, because most households maybe are feeling the pain. But most households are also over-allocated to this market. They hold a record share of equity, too, with equity at all-time highs. So you could pick apart really any aspect of this, and I think that gets to the point of dissents are good. Differences of opinions on the Fed are good as well.
Yeah, it's interesting. We've seen inflation in core goods pick up. We've seen inflation in food pick back up. We've seen inflation in energy rear its ugly head again. Healthcare inflation is coming back. And he's looking through all of that and just dismissing it, which I think is pretty fascinating. Let's get a check on what's going on in the markets right now. I guess this is a reason to be bullish stocks. Right now, S&P 500 up 0.2%, 66.85 the level there, and we have been trading here for about 35 minutes. The NASDAQ up about 0.5% at 24,874, and we are seeing yields float up a little bit. We had seen yields down earlier, but a real reversal when we got the new Philly Fed numbers. Right now, the 10-year at 4.0435%. Joining us at the desk is Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. And Marianne, guest after guest after guest. Paul Tudor Jones was on a couple days ago, and he said, look, inflation is running hot. It's going in the wrong direction. And this Fed and central banks around the world are going to continue to let that happen because we simply have too much debt, and the only way to deal with it is to inflate our way out of it. What's your take?
So if you use technicals, and if you look at the 10-year Treasury yield, and you go back from the peak of 1980 to where we are today, we've reversed that 40-year downtrend. So to a technician, that means interest rates are changed their cycle from a downtrend to an uptrend. Inflation is already here, and the rates market is saying inflation is going to continue over the years to come. However, we're in this environment where the Fed's going to cut rates, even with inflation not at their target. To me, that kind of just nails the coffin that inflation is not going to go back down to 2%.
Well, if you're worried about inflation, maybe buy gold. If you're worried about tariffs, maybe buy gold. If you're worried that markets are too overvalued with the equity market and with credit spreads incredibly tight, buy gold. I know you're very astute on technicals, and you looked at ETFs for a long, long time in your past career. What is that telling you? Can this continue to run even though the line has been up and to the right nonstop?
For gold. So for gold, everything is right for gold, whether it's inflation and all the other things that you mentioned. We originally came in the year with a target of 4,000, which we hit. And I had to raise that target. I do think we're tracking up towards 5,000. But now you're starting to see a lot of the other metals move. You're seeing silver trying to break out. And I think that silver will break out. Platinum, palladium, copper. This is a metal secular bull market. I don't think people are calling it a metal secular bull market, but this is a metal secular bull market.
I wonder if this is really a debasement trade. I mean, we still see and have seen in recent weeks strength in the dollar. I mean, you're a legendary technician. What do you see when you look at the dollar chart?
So what people are not talking about that they should be talking about is every major currency in the world is collapsing relative to gold. So if you want to talk about debasement, it's been going on for decades. And that's really the story. It's almost like the race to the bottom.
Right, but it's dollar debasement, right?
It's not just dollar. It's every currency compared to gold.
That's the conversation right now,
That's
right?
the conversation, which makes me bullish.
Because nobody else is getting super protectionist. Nobody else is slapping 100% tariffs on other countries, right? Nobody else is mass deporting millions of people. So this is the argument that policy is leading to, or could lead to, a reduction of the dollar in its place as top of the world reserve currency. I'm not saying that's what's happening.
Right.
I'm saying that's,
I don't think we're at that point.
Right.
If you look at the dollar, it's actually in an uptrend relative to the GFC. And we're in what's called a counter trend correction that I think now we've bottomed for the dollar and we've peaked in the euro. And I actually think from here, going into next year, the dollar can actually, stay steady and maybe even go up a little bit, which is kind of counter to what we're seeing with interest rates. That's what I find fascinating, is that the dollar's holding even with the market discounting a number of rate cuts.
So within the equity market, I know one of your favorite picks is Google. Why?
So I've been on this whole AI trade. That's the leadership.
You and a lot of people,
that is the leadership. The true leadership is in semiconductors. But Google was kind of left behind because it had a lot of legal things that were overhanging it from the DOJ. A lot of that's been lifted now. They also had the issue with search. There's concern, that with the, ChatGPTs of the world, that search will go away. But there's a lot more to Alphabet or Google than just search. And I still think it's one of the leaders in this market.
Yeah, I mean, it's underperformed massively this year, only up 1.5%, to your point, maybe further to run. Mary, wonderful to have you on. Thank you so much for joining us. Mary Ann Bartels of Sanctuary Wealth. Let's get a check on your markets this morning, because tech is still leading. See, Alphabet actually up 1.5% this morning, so a pretty good pick on a day like today. Elsewhere, we are up by 0.6% for the NASDAQ, the S&P up 0.2%, just about 40 minutes into your trading day. Yields are going nowhere fast. We were trending down towards 4%. The Philadelphia Fed numbers look really poor. You get an extra boost to that, so you get buying of yields. But that sharply reversing this morning. We're moving away from 5%. But even so, stocks move higher, Matt.
All right, let's get a look at some of the single stocks moving this morning. TSMC is actually lower after raising its projection for 2025 revenue growth for the second time this year. The chipmaker continues to benefit from a spending spree on AI infrastructure, as you would expect. And, the headline was, this is going to drive further bullishness. But as we were talking about with Mandeep, people who are in this sector, people who are steeped in this CapEx story, feel like maybe it's conservative.
Yeah, I also, the other thing I thought when it was originally rallying was you had the CEO saying that the AI megatrend is here. And I thought, who in their right mind saw that and said, oh, I'd never heard that.
I'd like
Time
to buy the stock.
Yeah, you'd assume everything is in the price. And maybe this is more logical. Speaking of AI and tech, Saleforce, they also expect revenue growth to return to double digits in the coming year. So those shares easily higher by 7%. They forecast $60 billion in annual revenue by 2030, Matt.
And UAL, United Airlines, delivering better than expected third quarter earnings. Last night after the bell, it said it expects brand loyal flyers and demand for its premium seats to drive profit through the end of the year. And however, the shares are down 2% this morning. It had a run up, obviously, especially post Delta. And so maybe this is buy the rumor, sell the news. On the other hand, maybe there are concerns about spending there as well, as we heard from Sid Philip.
Spending so much and is premium saturated and not much more room to run.
All right, coming up, William Blair's head of deal making, Matt Zimmer, joins us following a strong earnings season for the big banks. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. The Justice Department is set to ask a Maryland grand jury to indict former Trump National Security Advisor John Bolton over his handling of classified documents. If approved, the move would make Bolton, now one of Trump's most outspoken critics, the latest target in a widening effort by the Trump administration to pursue his perceived enemies. The Upper West Side is running out of new homes. Just 51 condos are set to hit the market through 2028. That's a 94% plunge from before the pandemic, and it's the steepest drop anywhere in Manhattan. Zoning limits, high costs, and neighborhood pushback mean only luxury projects make sense, leaving everyday New Yorkers priced out of one of Manhattan's most beautiful and beloved neighborhoods. I'm a big fan. The Statue of Liberty is nowhere near it. Your burrito might show up in a robo-taxi. Doordash is teaming up with Waymo in Phoenix to test driverless deliveries that keep the cars busy between passenger runs. The rollout will go wider later this year, and Dash Pass members will get Waymo ride discounts.
It just bums me out. We push everyone to the gig economy, and now we're taking their jobs.
I get it.
It just bums me out a little bit.
I totally get it. This is dystopia.
It is dystopia. How about we talk about utopia for the big banks? They wrapped up a very strong earnings season this week thanks to a surge in deal making. Goldman in particular posted a record third quarter revenue. CEO David Solomon gave an optimistic outlook.
We are the #1 M&A advisor globally, well positioned to capitalize on the upswing in investment banking activity, which we expect the next 12 to 24 months.
Many of our clients have navigated and adapted to the current state of play. Though near-term policy considerations are still relevant, many CEOs have shifted their focus back to long-term and strategic decision-making.
Joining us now is Matt Zimmer, Global Head of Investment Banking at William Blair. Matt's team advises on 200-plus transactions annually. Matt, wonderful to see you. Thanks for joining us this morning.
Thanks for having me.
So, Solomon, optimistic that the uptick in flow we've seen in deal activity is going to continue. Are you equally as optimistic?
Yeah, I think so. Where we participate in the market, for what it's worth, is kind of the $500 million to $1 billion, $2 billion type zone. So we'll do 250 transactions this year. And that market is about 15 times as large as the mega cap deals in terms of deal flow and deal volume. Our team is set up across multiple sectors: healthcare, tech, industrials, services, aerospace, and defense. And so we have a pretty good pulse on what's going on in that M&A market. About 2/3 of our deals are for private equity. So we're heavily indexed into the private equity world. And that's where we see a lot of opportunity coming.
So you're buying companies from private equity, or, I mean, they're exiting and you're helping them do that
Correct.
transaction?
Yeah, so we'll be the M&A advisor selling a portfolio company for a private equity firm.
Yeah.
I saw a data point yesterday, there are 29,000 portfolio companies inside of private equity firms held today. 5 years ago, that was 22,000.
I'm just trying to suss out if they're doing more purchases now, or if they're actually starting to do a lot of exits.
They're starting to think about exits in a more material way. There's been a logjam in the private equity world. If you think about the market acquiring a business in, say, 2021, multiples were very high. You're 4 or 5 years later, multiples maybe are not as high, and most of these private equity firms are trying to figure out ways to get liquidity and sell.
Yeah.
But they're not willing to, and so you see a huge inventory of assets out there.
Because I wanted to ask about that, because LPs, their investors, have been furious. There was this great Bloomberg anecdote that apparently at some investor day, someone was wearing a shirt saying, like, DPI is the new IRR, which is a nerdy way of saying we care more about you returning money than actually how much you return on the investment itself.
Yes.
So if they're starting to think about it, are they willing to take a haircut? Are they willing to sell at valuations that are lower than they otherwise would have been happy to?
So that has been the logjam in the market. And I think most of the institutional investors out there, the LPs, are now saying, I'm not going to give you money for Fund 7 until I get money back from Fund 6 and Fund 5. So we need liquidity. Private equity firms are getting to the point, I think, where they're going to have to acquiesce a little bit on value. They may make 2 times their money, not 3 times their money on an exit. And we're starting to see that materialize a little bit.
By the way, are you needed? Do I have to have an advisor when I'm using Fund 7 to buy a company from Fund 5?
Absolutely. William Blair, by the way, for what it's worth.
Yes, of course. I'm just saying, like, for the continuation vehicles,
yes.
Do they still need M&A advisors?
So there's an entire new product and expertise in the secondaries market. We built a 60-person secondaries team, essentially.
Amazing.
Doing continuation vehicles, essentially, today. You know, that's been a pretty elegant solution for a lot of these GPs, these private equity firms, to get liquidity to their LPs without having to necessarily sell the whole company. So the team we built, they're really busy right now.
Obviously, it's a great thing for business, but I was speaking with Orlando Bravo of Thoma Bravo last week, who was railing against this. I mean, they've done really well with exits, but he was saying the job of private equity is to buy a company, make it better, and sell it.
Absolutely.
Like, that is part of the job.
Absolutely.
So when you look at this, are you saying, oh, this is a creative solution for this current logjam, or is it, like, problematic that they've kind of found a way to at least temporarily get around that third goal of theirs?
Well, I think the secondaries product, the continuation fund, historically was a mechanism to kind of clean up legacy portfolio companies and put them in a new fund and hold them longer. Today, what you see is a lot of these private equity firms saying, we want to hold our best companies for longer. We don't want to sell it necessarily right now. And so, to me, that mechanism is set up to say, let's allow our LPs to get some liquidity. If they want, they can opt in or out, put it into a new vehicle, and own it for another 5, 6, 7 years.
How has this restrictive rate environment been for you? I mean, it doesn't seem restrictive when I see $1 trillion in M&A headline over a quarter, but the Fed insists that it is and is going to cut rates. So what does that mean for William Blair?
Yeah. The M&A market will continue to improve as rates come down, no question. I personally would like to see kind of a slow, gradual, declining interest rate environment. Obviously, you need to watch inflation.
Like forever.
Forever.
Yeah.
Obviously, you need to monitor inflation and understand what the market is. But honestly, the cost of capital in those scenarios, you buy a house with a cheaper mortgage, you can pay more, right? It's the same kind of dynamic in the M&A world. So cheaper debt will drive increased M&A volume in the future. And I think that tailwind, plus this massive inventory of portfolio companies that are out there, sets up for a very promising M&A market for the next couple of years.
I have to say, sometimes I feel crazy talking about how strong things are looking and the fact that it was only at the start of the year that businesses had no idea what was going on with tariffs.
Right.
And that complete supply chains were upended. We got a taste of it again on Friday with,
Yes.
with the president talking about adding more tariffs onto China. Is that registering for companies? Or are they still going forward with M&A exits, IPOs, and they ignore what's ever happening with the geopolitics now?
I think it depends on the industry in which the company participates. So in our business, when Liberation Day kicked off, our industrials team, as an example, was representing clients who were sourcing products from outside the United States. Everything paused. We had clients that said, we just cannot forecast our business right now. That said, services businesses, software businesses, healthcare IT businesses, things that were less exposed, went ahead, and they actually became, relatively speaking, more attractive, and the multiples in those sectors jumped up. I mean, today's environment, with the current situation going on, I think we just need to see where things land, because it is just moving around every day.
I wonder, I've heard from private equity guys about how difficult it was to do cross-border deals, especially with countries that don't necessarily like us that much, during April, during May. But what about here in the U.S. with the government closed? Does that make things more difficult when you want to talk to regulators, when you want to talk to the IRS?
It does. I would say the SEC and the FTC. In the M&A world, you sign a transaction, you need to get HSR approval, antitrust approval. That entity has been downsized. For the transactions that have no risk, and it's just a clear, it's okay, rubber stamp, those are progressing. Where the ones where there are red flags, with a leaner team in place at the FTC as an example, they say we have questions on this transaction. It may take a little longer for it to close. And that's what we're in right now. On the IPO side as well, SEC, a lot of companies need to get final clearance, leaner team in place at the SEC. Some of those IPOs are getting held up at the same time.
Fascinating stuff.
Yeah.
Hey, great having you in the studio. Hope you can come back. Matt Zimmer there runs the M&A business for William Blair. Still ahead, meet the man behind the first ever solar-powered EV to list on the NASDAQ and to drive a decent amount. There have been solar-powered cars before, but this one...
None that look like this, though.
It looks particularly interesting and it's special. Chris Anthony, co-CEO of Aptera, joins us. This is Bloomberg Open Interest. Let's get a check now on the markets. We're looking at S&P 500 up 1/3%, closing up about that much yesterday as well. So back-to-back gains, NASDAQ up 0.7, and we have yields really little change right now at 350 on the 2-year after it had dipped down to 348, the 10-year at 404. Coming up, we're going to talk to the man behind, the company behind the first solar car to list on the NASDAQ. This is Bloomberg. All right, we are looking at markets that continue to rise here. The S&P 500 up about 3/4%, just about where it closed up yesterday, driven again by AI after TSMC raised its forecast, although ironically TSMC itself is actually down right now. I continue to focus my attention on the world of automotive because it seems to be what drives global trade, and that is what drives flows. However, Ferrari is a different story as usual. The stock has been under pressure since the luxury automaker delivered a more cautious than expected outlook. And last night, I got a chance with Katie Greifeld to speak with the Ferrari CEO, Benedetta Vigna, came in yesterday and talked to us about some of the changes that the company is making to its product.
Look, we said clearly that we are a big fan of phygital. It means that you use digital where it's needed and physical where it's needed. I can tell you that all the time this year we presented the 5 cars, the 2 Speciale, 6-cylinder, the 2 Testarossa, Spider and Coupe, and the Ferrari Amalfi, when we told our client and the entire world that we are going back to the button where you feel it, okay, without touching, without looking, because when you drive you need to look at the road. Well, that was a big, big applause we had. So we will use digital where it's needed and physical where it's needed.
Can I just ask about the shifters? Because I spend so much time on Bring a Trailer. I'm looking at 360s, I'm looking at 430s, you know, sometimes 575s and 612s. And I noticed that the premium for a manual is massive, 50, 60, 70%, sometimes even double for the manual car versus the auto box. So doesn't that mean customers want to buy that new too?
Look, you have to listen to client for something. For something else, you cannot listen. For something else, maybe some good hint for the future.
So maybe in the future you can just make a suggestion box and Matt can put his comments directly in there.
He has to come to see us.
There you go. Before we let you go, I do want to talk a little bit about China, because you take a look at some of your peers in Porsche, BMW, Mercedes on a slightly different price point there, but they're rapidly losing market share when it comes to China. And I wonder, you know, when you look at that, are you confident that you're going to be able to buck the trend there?
But since the beginning, at least since I joined the company, we said that for us, China is, mainland China, Taiwan, and Hong Kong will be below 10%. That's what we said recently. I think that last year, Ferrari did not have an offer that was fitting well the Chinese market, because we were having only 12 cylinders and we had a Roma Spider with soft hat. It's not so welcome. Now we are going to change. We are enrich, let me see the offer for China. Electrica could be also a good, interesting car for them, also because you will not have all the taxes that you have on ICE.
That was part of my conversation with the CEO of Ferrari, Benedetta Vigna. Be sure to tune into my podcast, Hot Pursuit. We put out episodes weekly for car lovers. You can find it on Bloomberg Radio, Apple Podcasts, Spotify, or wherever. Just search Bloomberg Hot Pursuit. And clearly, I'm the car lover, right? Katie Greifeld is the business journalist, right? Because I'm like asking him about, you know, the buttons on the steering wheel, and he's telling me he's implying that there could be a stick shift again, a gated shifter, a manual transmission in a new Ferrari.
Do you think that's painful for him? He's a chips guy, right? That's his background. He probably enjoys much more discussing what chips go into the car than putting a stick shift back in.
He used to run ST Microelectronics, but he is also deep and dirty in the world of cars. Like, he loves to drive, he loves the product, and he listens to customers, right? And this is what customers are asking for. But I just thought it was funny that Katie then, he says, he lets a bomb drop. He says, we may put stick shifts back in cars, and Katie's like, what's the business like in China?
I don't know, maybe China cares about stick shifts. Maybe there's a...
She's all about the numbers. The thing is, China does care about electric cars, right? They have much bigger adoption and broader acceptance for that.
Also cheaper electric cars too.
Right, and Ferrari is going to make, you know, its first fully electric car for sale next year. Michael Dean, who works for Bloomberg Intelligence, was at their Capital Markets Day and said he looked around and all the battery boxes from SK1 did say made in China.
Interesting.
So, the cells, I mean, you know, almost all battery cells are made there, so.
Yeah. Fair enough. And I think there was a story about a different battery company in the U.S. struggling with getting funding removed that they had, from the Biden administration that they won't have anymore. A quick check on markets this morning, Matt, about an hour into your trading day. Still up 0.4%, easily higher than where we were on Friday. The market rupture after President Trump talked about additional tariffs to China. That story is moved by the wayside. Instead, we're bidding up tech this morning, up by 0.7%. Your bond market changes to little changed. We were moving towards 4% on your 10-year yield. Now we're trending slightly higher at 403.78, Matt.
Let's get a look at some of the single stocks moving at this hour. Charles Schwab reported third quarter earnings that beat estimates as the firm benefited from a surge in trading. This is what we've seen at the big banks as well, with Morgan Stanley knocking the cover off the ball. But everybody doing well because a lot of people are trading stocks, and the same is true at Schwab.
Yeah, they said openings of new brokerage accounts topped 1 million for the fourth quarter in a row. Maybe that's why stocks never go down, because there are so many people there just to buy the dip.
That's possible. Definitely retail is buying the dip for sure. Hedge funds are a little bit twitchier right now.
That's fair enough. Elsewhere, we did see HPE delivering a disappointing profit forecast that reflected a margin crunch in the AI era. They also said that it's planning to cut jobs as part of its integration with Jupiter Networks.
And J.B. Hunt reported better than expected earnings, citing better cost control measures. The results come as the freight industry remains muted after years of weak shipping demand. But you can see that this has powered J.B. Hunt shares higher. I mean, rising by almost 20% in one session is just, to me, fascinating for a company that has, as far as I know, nothing to do with AI data centers. Although,
it's such a good point. Yeah. It's very rare to see that kind of move unless you're an AI company.
Maybe they're just shipping around, GPUs, truckloads full of NVIDIA chips.
You know who we can ask about that? Let's ask Lee Klaskow. He's our senior transportation and logistics analyst for Bloomberg Intelligence. I mean, Lee, it is a monster of a move. What's behind this optimism?
Yeah, so it's a great move today, and it's really been driven by the fact that they handedly beat expectations when they reported third quarter earnings after the close yesterday. It was really driven by kind of a self-help group, not necessarily a macro trend, and that self-help is just reducing costs. Last quarter, they said that they were going to try to reduce about $100 million and try to get some productivity out of that. That $100 million was expected to be mostly in 2026, but they really did a pretty good job the first 3 months of their efforts, and they were able to reduce costs by around $20 million, which really equates to about 16 cents in earnings. And that really was the thing that helped drive earnings well below expectations. And the sell side are probably going to be pushing their numbers higher for the fourth quarter and first quarter and second quarter of next year. We would also say that they did get some help below the line. About 5 cents came from lower interest rates, tax rates, and less shares outstanding. But net, it was a pretty good print. They were a little more constructive on the peak season, which was a little surprising to us because everything that we see is calling for a pretty tepid or muted peak season this year, and that's just really being driven by the fact that a lot of freight was pulled forward ahead of tariffs, and B, the consumer appears to be weakening a little bit, at least when you're looking at some of the economic data out there. But net, it was a very I would say positive call. And management was, like I said, a little more constructive on the peak season. And they talked about, rates. So truckload rates have been very depressed for a very long time for those that follow the market. We've been in a freight recession for about 3 years. Spot rates have been inching up a little higher over the last couple days and weeks. And that's really being driven, at least from our vantage point, from the increased enforcement of some federal laws that are on the books when it comes to truck drivers have to have a certain proficiency in English, in speaking English and understanding English. And so, we've seen that. And also, there is going to be a stoppage of issuing non-U.S. domiciled CDLs. And then when those CDLs, those non-domiciled CDLs come up for renewal, the government is probably not going to renew those. So that could take some capacity out of the market. And like I mentioned, freight rates have been pretty depressed over the last couple of years, and that's really been driven by slack capacity in the market.
So maybe fewer people chasing that long white line. Lee Klaskow, Bloomberg Intelligence, talking to us about J.B. Hunt. Thanks very much for that. Coming up, TSMC and Saleforce both forecasting stronger revenue growth than the market had anticipated. We'll talk tech later this hour. This is Bloomberg Open Interest. A very unique vehicle is getting closer to hitting the highway. It is a solar-powered EV. Aptera Motors starts trading on the NASDAQ today under the ticker SEV, Solar EV. The vehicle can run on solar power alone for 40 miles a day or drive 400 miles on a full charge. Joining us with more is the company's co-CEO, Chris Anthony. And Chris, this is fascinating. Especially, I think, to me, but to everybody, when you see the car, people are immediately like slack-jawed. How did you get the idea to start this, and how have you brought it this far?
It's really examining how transportation exists today, and that most vehicles are very inefficient at highway speed. So a typical sedan or SUV today uses almost 70% of its fuel just pushing air out of the way. So if you made your vehicle much more aerodynamic, you get 70% better fuel economy. Then if you tackle weight and drivetrain efficiencies, you get something that can get over 350 miles per gallon equivalent. And that's the EV that we have. You put solar power on it, and you can do all of your daily driving without ever having to plug it in. Just leave it out in the sun, and you can drive.
Can I ask you who this is envisioned for? Because it is such a specific look. I'm going to be honest, I would struggle to be in this because I'd be like, everybody is looking at me in this thing, and I feel deeply uncomfortable about that.
And they would be. Everyone would be looking
at you. It is a two-seater, so it's not like you can like take the kids to, you know, whatever sports practice they have. So who is like the end user, the customer that you're building this for?
We have almost 50,000 orders now, so we get good intel on who those customers are. And it breaks down into really four segments. People that love the environment and want to do better. People that want to cut costs. They don't want to pay for fuel. They don't want to pay for electricity. People that are just engineers and love the future-facing technology that this is. And then people that just want to look unique. In our Instagram world, driving a solar-powered spaceship is definitely going to kick up your Instagram.
So $100 reservation fee, and my buddy Joe, he's always looking for a car. How much is he going to have to pay for this?
About $40,000 for the launch edition. That gets you 400 miles of range and full solar, front-wheel drive, lots of storage in the back, and something that's just really, really useful. One thing is we don't have to install a big charger at your house to charge this EV. Most of the power is going to come from the sun, but if you drove to see grandma 300 miles away, you can come back, and with just an extension cord out of your garage, you can charge 150 miles back into the Aptera.
And the launch edition, when's that going to get delivered?
We're hoping to raise funds here with this listing and be 9 to 12 months before we're in production.
So at about $40,000, I could also buy a Tesla Model 3 or Model Y for the same price. Are they your competition in this?
Yeah, we're really creating a whole new category. A vehicle's never existed that creates its own fuel. A really cool aspect of the Aptera. You can drive 200 miles to your favorite camping spot. You can camp for a week. You can actually come home with more fuel in your Aptera than you left with. So a vehicle category that creates its own fuel, that you don't have to pay for gasoline, you don't have to pay for electricity, it's just never existed. So when you calculate that into the value proposition of the product, we think $40,000 for a 400-mile range Aptera is a steal.
I think obviously the engineering and the design and, all of that is so fascinating. But the boring stuff is what I wonder about, like getting NHTSA approval to put this thing on the road. How hard is that?
We're technically a motorcycle, so 3 wheels get you into the high occupancy.
Is that why? Is that why it's a 3-wheeler?
Well, it's mostly because of efficiency. You ditch the 4th wheel, you ditch that weight, you ditch the extra rolling resistance, you ditch the frontal area that causes you aerodynamic drag. So for us, it's all about efficiency. It just happens that if you're a 3-wheeler, you end up being a motorcycle. And that puts us in a different regulatory category. We're already a federal motor vehicle manufacturer. We can ship and sell vehicles today, but we will go through crash testing. We'll go through a lot of prove-out and validation over the next half year in preparation to start production and start delivering to our 50,000 eager fans.
Well, Chris, I hope more are on the road, honestly, so I can just look at them. It is a wild-looking car. Very exciting. Chris, thank you so much for joining us. Chris Anthony of Aptera, which is listing on the NASDAQ. Turning to more tech stories, TSMC has hiked its revenue outlook as the spending spree on AI infrastructure continues, but shares are down 1/3%. Let's get more with Peter Elstrom, Bloomberg executive editor for global technology. Peter, the CEO saying that the AI megatrend is here, saying that, but are they also being conservative with their outlook?
Yeah, well, we're starting to get a full picture of what's going on in the chips business. We got Samsung preliminary earnings at the beginning of the week, and they had their highest profit in 3 years. And then we got ASML, the chip equipment maker. They came out with a very strong forecast also. And now we're getting TSMC, which is really the biggest, the most important chip maker that's out there. They hiked their forecast for growth. And it was the second time in 3 months that they've been doing that. They say, as you mentioned, C.C. Wei, the CEO, talked about how this AI megatrend is really getting stronger at this point. And we're seeing that. We're seeing their investment step up. They said they're going to invest more money than they had anticipated before. They're watching the spending from NVIDIA and OpenAI and Oracle and some of these others, and they see that this is going to grow for them going forward. So I think it's a positive sign. The stock now is a little bit softer in the ADRs here, but the TSMC shares have been on quite a run already, so I think it's giving back a little bit of those gains.
Is this, I mean, it looks like this kind of growth at TSMC was already priced in. The shares are actually trading down. So have you heard anyone say this is like too conservative from them?
Well, I think TSMC tends to be a little bit conservative in its forecast, like many companies. Again, they did raise their forecast just 3 months ago because they thought there was pretty strong growth at that time. They're boosting their forecast again here. And they do anticipate that revenue is going to be quite strong going forward. I think what they need to really understand is whether some of these new financing vehicles that we've seen from OpenAI and NVIDIA in particular are going to pay off and allow these companies to make the investments in the chips that TSMC makes for the likes of NVIDIA, and whether they're going to be able to put those in data centers as quickly as they anticipate. The numbers we're hearing are kind of off the charts at this point, especially from OpenAI and their build-out and some of these other data center operators. So if they can execute those numbers, that's going to be good for TSMC.
All right, Peter, thanks so much for joining us. Peter Elstrom there runs tech coverage for us. Coming up, President Trump is set to speak with Russia's Vladimir Putin today. We're going to get the latest from Washington. This is Bloomberg Open Interest.
President Trump will speak with Russia's Vladimir Putin today before meeting Ukraine's Volodymyr Zelensky at the White House tomorrow. It's a packed schedule. Joining us is Bloomberg senior editor Mike Shepard. Shep, how does this conversation between Presidents Putin and Trump set up the one with Zelensky?
Well, tomorrow's meeting with the Ukrainian leader was one where we thought we would see Volodymyr Zelensky ask the U.S. for help on two fronts. One is more weapons, and specifically more longer-range weapons to reach deeper inside Russia. And two is the energy front. The winter is coming, and Ukraine will need access to energy supplies to be able to get through those cold and bitter months. Now, this call with Putin today sets the stage for that meeting. Donald Trump has been frustrated with Vladimir Putin over his refusal to actually meet halfway in trying to end the war in Ukraine, which has been a goal of the U.S. president since taking office in January. It has become a source of frustration. And on Sunday, we saw Donald Trump even raise the prospect of threatening to send U.S.-made Tomahawk missiles to Ukraine if Vladimir Putin doesn't cooperate here, Dani.
What do we know about the president's willingness to really engage Vladimir Putin like that? How close are those two?
Well, you know, the U.S. president has tried, Donald Trump has tried since taking office to do what he could to reach out to Vladimir Putin and try to engage him in a way that the prior administration did not. He has sent his envoys there to meet with Putin. He has had his own meeting with Putin. The two men have had a number of phone calls, and the president has really tried to put Vladimir Putin and Volodymyr Zelensky more on a level playing field rather than viewing Putin as much more of the aggressor in this conflict. And this is all in a bid to achieve Trump's aim of ending this war in Ukraine. We're more than 3 years into it now, and Trump has repeatedly decried the bloodshed there, and he has made it a goal. It was a goal during his campaign to win back the White House, and it has remained a goal for him. And now he is feeling some momentum coming out of the agreement that he just unveiled at the start of the week to reach some sort of a halt in hostilities and create a path for peace in Gaza. And he's trying to use that momentum to show both Putin Biden and Zelensky that, look, there may be a path here to end this conflict.
Shep, we can't let you go without asking about what the latest on conversations with China is. A back and forth, a threat from Trump, moving from one thing to cooking oil to the next, with Scott Bessent's optimism of the two meeting. Where do we even stand?
A wolf warrior. Don't forget the wolf warrior.
Correct. Can't forget the wolf warrior.
Wolf warrior. And going rogue. The rhetoric is really heated. And it's just as important to watch the actions, too, from each side and what they're offering. The U.S. is offering not nearly what Beijing would expect from the escalation that it took with the curbs that it is proposing on rare earths exports. And what the U.S. is banking on is that it will get some support globally. We heard Jameson Greer, the U.S. Trade Representative, say yesterday, look, he is skeptical that China will actually follow through on this threat to put those export curbs on rare earths into place simply because of the global fallout. There are so many other trading partners, not just the U.S., that depend on these rare earths elements across a wide range of industries. And the U.S. is already trying to engage allies, including the Group of Seven, to see if they can counter China on this. And for that reason, we're seeing the U.S. make this somewhat lowball offer of extending a tariff pause rather than throwing in other things like perhaps a relaxation of American export controls.
All right, Mike Shepard, pleasure having you on the program. Bloomberg's Mike Shepard covers all things politics for us out of Washington. Coming up tomorrow, Nadia Lovell joins us from UBS, Amy Wu Silverman of RBC as well. And it's going to be Friday. This is Bloomberg Open Interest.